Thank you, Ramraj, for a great session. Welcome everyone to the first plenary panel of Prabhav 2020. This is Neha, and it is my pleasure to welcome you all. This is the first plenary session titled Impact Investing During Current Times, Perspectives from a Global CEO Panel. The agenda of the panel is really to discuss and debate on the global impact investing trends, what's happening to the impact world, what's happening to the sector post-pandemic, and what are the changes we may see in the industry in a post-COVID world. We have an illustrious panel, and I'm sure we are going to benefit tremendously from their deep insights into this space. This panel will be moderated by Rupa Kurva, Managing Director of Omidyar Network, and it is a pleasure to have her moderate the panel. Thank you, Rupa. Our panelists today are Thos Kieses, Managing Director of Cooperative International, Adam Wolfinson, Managing Director at Untitled Chapter, Ross Piper, CEO of Christian Super, and Anita George, Executive Vice President at CDPQ. I welcome all the panelists, and over to you, Rupa.
Thank you, Neha, and good morning, good afternoon, good evening, everyone joining us today. I believe we have a fantastic representation from all over the world. And to match that, we have this truly global panel here today. And I feel really delighted to see that we have folks on this panel from Brooklyn, from Amsterdam, from Sydney, Delhi, and Mumbai. You can't get more global than that. I think we are really looking forward to a very wide-ranging discussion today, getting our panelists' views on the trends in the impact investing industry. What are their own organization priorities now, given these unprecedented times we find ourselves in? What is their current work in India, and how are they thinking about their work in India in the future? What does India, in their opinion, need to do to attract more impact investing capital? And we will also touch upon what does the word impact really mean to them and their organizations. So looking forward to a great conversation. Let me jump right in and start by asking all the panelists very quickly to describe, your work in India so far. What really is the range of your activities? How much have you invested? What are your focus areas? And really, given everything that's happened, what are your top 2-3 priorities for the next? And let me begin with Anita, and then I'll come to the others.
Thank you very much, Rupa. I'm very happy to be here with everybody on this panel, and to be a part of the impact investing world, actually. We are Canada's CDPQ, Caisse des dépôts et placements du Québec, Canada's second largest pension plan fund manager. And we have about 329 billion Canadian dollars under management. And India is a relatively new market for us in that we've been here just for short of 5 years. And in this time period, we've invested about 6 billion Canadian dollars across all the asset classes that we have. So starting with infrastructure, mainly in renewable energy, and then real estate, both on the residential side as well as logistics, for which there is a big need. And then listed equities, where we do direct investments plus through funds, and private equity, again through funds as well as direct investments, and what we call fixed income. So across these sectors, we've been working in India. On the impact side, I would say our biggest contribution has been in terms of the partners we select, who have a track record of investing in the right way, taking into account the E, the S, and the G. And that's a very important aspect for us. And the second is really through our extensive work with entrepreneurs, both here locally as well as giving entrepreneurs in India the opportunity to interact globally with our businesses across the world. So I'll stop there.
Great. Thank you. And let me go to Thos next.
Thank you very much, Rupa, and thank you for having me on the panel today. So Curated is a cooperative institution founded about 45 years ago. 1.3 billion euros under management. In India, since 1978, the first loan we did actually was back in 78 already, a housing project, which was very interesting. Today, we've grown into a size of about 125 million euros in terms of credit facilities and about 45 million in equity. It's all private equity. So we invest in organizations that either work in the field of financial inclusion or in renewable energy or in agriculture. But all of it is aimed at actually the people at the bottom of the pyramid, as we call it, to enable them to have an option, actually, through our partners to improve their lives. So whether that is in financial inclusion or in agriculture or renewable energy, it has to have a very strong social component. Our investors expect that of us more than a financial dividend. They would like a financial return. They would like to have a social return. So that's what we're doing. I'll keep it at that for now. Yeah.
No, thank you. And I know you think very deeply about impact, and we will come back to that later in the conversation. Let me move on to Ross next.
Thank you, Rupa, and delighted to be a part of this panel. Sorry we can't be there in person, but really, what a time for us, I guess, to be reflecting on challenges and opportunities around impact. So for myself, CEO of Christian Super, so we're an Australian pension fund, around about 1.5 billion US under management, and it's a fund that is very well known for its work and its pioneering work in the area of ethical and impact investing. So we've had an impact asset class for around about, the funds are around about 35 years old, but for the last 15 to 20 years, a very deliberate move into impact investing. And India, of course, is one of many emerging markets where we have a fairly broad exposure. As a pension fund, we're heavily regulated. We're fiduciaries, and therefore we need to operate at the market rate risk-adjusted end of the impact spectrum. In terms of exposure in India, quite a diverse range of investments, majority in private equity, a very small debt component. And in terms of sectors, quite broad again, investments in healthcare, financial services, industrial logistics, energy, and agriculture, and the modality or the structuring of those investments varies quite considerably. Fund of funds as well as some direct as well. That's an overview of where we are and the exposures we have in India.
And Adam, if you can kind of speak about what you've done in India as well, and also take up, the next question, which I will like to kind of move to now, which is also, how do you think the global impact investing space is going to change in the aftermath of the pandemic and the consequent economic shocks? That would be great as well.
Sure. So first of all, thank you to Prabhav for having me today, and to all my co-panelists. I love this event, and I'm very, very sad that not to be there in person, and looking forward to when we can all be together next time. Encourage Capital, we are about 10 years old or so when you combine all the Wolfenson Fund Management, which was our previous organization in India, and Echo. Over the years, we've invested about $75 million in India. We're only do impact private equity, and companies like Fab India, Ujjivan, Repco Home Finance, mainly financial inclusion and clean energy, although some margins around that broadly over the years. Currently, our focus is really at that intersection between financial inclusion and climate. We're investing in NBFCs, focusing on rooftop solar in the MSME market. Most of what we do is quite outcomes-oriented impact investment in that space. And then we'll work globally, but India is probably the area of greatest focus for our firm. on both the advisory and that's more on the consulting as opposed to transaction advisory and the asset management side. And then look, in terms of how will the impact investing space change in this pandemic, I certainly, first of all, this has been an extraordinarily, a year that none of us have predicted. So, any prediction is with a major grain of salt. But a couple of observations, especially, also being active during the global financial crisis. And, to me, this feels very different to that time in a couple of ways, which might signal how the impact investment world might change after this time. During the GFC, I felt there was, everybody was hitting the brakes and, hiding under their desks for a good long time, myself included. And I do feel, though, that there's much more of a sort of proactive, counter-cyclical, front foot sort of culture right now for a number of reasons. I mean, first of all, of course, you've got a different policy response, and the markets are doing different things and rebounding. But I also think that people are really starting to understand. Everybody on this panel has been talking about, systemic risks and inequality and climate, that face, our entire economy and an entire planet for many years. And all of those are really being made manifest this year. And I think that you see both, historical impact investors doubling down and saying, if not now, when? And you have foundations issuing, hundreds of millions of dollars of bonds to double down on both their investing and their grant making. You have family offices stepping up and going into 100%. And you've got institutions realizing, wow, this is really existential. And so we need to double down into impact. And what these crazy people were talking about actually seems to be quite germane to our lives and to all of our investing. And so, you really do see, I think, a new seriousness to look at systemic threats and systemic solutions. You see mainstream asset managers launching impact funds. So I really see an acceleration and a new seriousness to reevaluate global capitalism. I also saw that during the global financial crisis, and it was short-lived, but hopefully it will be longer-lived this time.
Ross, what are your perspectives on this? And, Adam talked about people doubling down. I think one of the key questions is that if this is prolonged, one can understand impact investors doubling down on areas that they know well or entrepreneurs that they know well. But what about in a pandemic-like situation, the ability of investors to evaluate and get into newer areas as well? So how do you think overall this, at the highest level, yes, there's greater interest, but how do you think it'll actually play out?
So I think to speak to maybe an Australian perspective on this. So in Australia, the pension system is it's a compulsory system, but consumers have choice. And so there's a really interesting intersection. Obviously, COVID has had global economic impacts, and the things that Adam has just highlighted, I think, are all issues that investors need to weigh very carefully. But interestingly, in our own market, we've actually seen a significant, I'd say, upweighting of consumer activism in the last 3 or 4 months. And there's been a number of quite high-profile cases where, at a very, very significant level, corporate change has been brought about through shareholder activism. And so all of this, I think, points potentially to an awakening consumer activism or an awareness. Now, the cynics may say this is because everyone's sitting at home and they've got more time to surf the internet. But I think there's actually potentially a larger groundswell or a shift in perspective around the role of capital. And so to speak to the impacts of COVID and whether COVID is a headwind or a tailwind for impact investing, or is it too early to say? I think in some ways we're certainly seeing consumers engaging in different ways. I think there's an interesting question about the performance of impact investments, and clearly there is a very significant set of impacts that underlying investment asset classes, microfinance or things like that, are all navigating. There's very significant challenges around those things, but I also think there's a strong view that any kind of post-COVID recovery will require deep investment and activity from particularly financial services organisations in emerging markets. And so I think there's massive opportunity that comes with it. And again, back to the Australian context, where we've got consumers who are now starting to vote with their feet more than they ever have before about where they want their pension to be placed. People want good financial returns, they want low fees, but actually they care deeply about what their money's actually doing. And so I think there's an interesting groundswell shift there, and it does present a significant opportunity in the impact investing market.
Great. Thanks, Ross. Thos, your perspectives?
Yeah, very interesting to hear both Ross and Adam. And I don't think I share their optimism as much because I do see consumers actually becoming more aware of what's happening with their money. But indeed, as Ross already said, the return is going to be extremely important, and I'm not sure how insistent people will be. And if they do want impact, then okay, what sort of impact is it that they're really after? So we see the whole industry moving to impact, which is fantastic. But does it really get to the bottom end where it's most needed? And I think because of COVID, and nobody knows for sure how deep the pain is going to be felt really with the poorest people on earth, and how much is destroyed there, and how long it will take to build that back up. And is there enough capital out there that is actually willing to be so patient and foregoing actually financial returns to get that back on track? So there's an awful lot to be done, but I beg to be a little bit cautious to see whether everybody puts their money really where their mouth is.
Yeah, and I think that note of caution, Thos, is not entirely misplaced, right? Because I think translating a desire at the highest level to actually what it means on the ground in terms of dollars being deployed is a different question altogether. Anita, I think the question for you really is, in the midst of all this churn that we are seeing, a questioning of, a greater focus on ESG, a definite focus on increasing resilience of the worst affected sections of society and the population, and the fact that as pension fund managers, you are at the market end of the spectrum. What will it take to get more pension funds and insurance companies to deploy funds towards impact investing?
Thanks, Rupa. I think just to start with, I would say if you took the broad ESG, on the E and the G, there has been a growing commitment, and it's coming from the point of view of saying that these are real risks and we need to take them into account so that the risk-adjusted return for our pensioners is what we think that it will be. And so I would say that especially on the environmental side, for example, CDPQ ourselves, in 2017, we committed to reducing our carbon footprint by 25%. And, having a portfolio that was not that easy to do that, it's commendable that we did put our money where our mouth is. And you'll be impressed to know that our individual bonuses are based on whether we meet those targets or not. So even the youngest analyst in our group is questioning where we are putting our money. On the governance, I would say, because we are global, we have tried very much to sort of raise the bar in terms of bringing in corporate governance, transparency, all those things which we think will go towards really having an impact in terms of the reliability of business outcomes. Where I see a big change coming is really on the social. And that's probably the hardest part for investors like us to get our arms around it. However, if COVID has kind of underscored something, it is the rising inequalities. And I think that we have tried to address parts of it. For example, really focusing investments in emerging markets in a way that builds long-term businesses in green energy, etc. At the same time, also contributing. There is a network of investor leadership network, which has 6 trillion under management. And these are CDPQ, all the other Canadian pension funds, as well as some of the institutional investors like insurance companies, etc. And collectively, we've committed to increasing the capacity in emerging markets for infrastructure investment, which we see as very key to economic growth, etc. And then the third leg that this group is working on is diversity and inclusion, which again goes back to the social fabric of the different societies that we operate in. So that CDPQ just signed the sort of commitment to diversity and inclusion in across all our businesses. And we have explicit parameters that we are going to be monitored on and that our investee companies are going to be monitored on. So I, like Adam and Ross, I'm a little bit more optimistic, thoughts, because I think when capital starts moving, that's when we will see the real move in the needle. If you remember 20 years ago on the environment, I used to be in IFC, and I remember it was something that we thought was a burden rather than something to be proud about and really bring about change. And what we've seen in the last 20 years is that has become more or less mainstream. So now we really need to work towards how do we get large investors to have an impact also on the social side. And I think here is where the impact investment community can really sort of be the pioneers.
Right. And then that does get into the question, though, of what really does social impact mean. And as you said, compared to environment and governance, it is probably a tougher piece of the puzzle to crack, but we'll come to that. All of you are really observers and participants in the Indian market for decades. And there's so much expertise and insight on this table. I'd love to hear your perspectives on what you think are the Indian impact investing industry's two biggest strengths and what are the two biggest challenges. Because for all that we talk about impact, India being a hub for social innovation, and the fact that the impact investing industry in India has grown tremendously over the last decade. In fact, IIC just published a fantastic report on that as well. The fact remains that we still account for less than 5% of global capital deployed on the impact side. So clearly there are some challenges that are coming in the way. So if you could just share your perspectives on two strengths, two big challenges that we need to address to get more money flowing into the Indian impact investing industry. And let me begin with Adam.
I'll unmute. Thanks. It's a great question, but one thing to note just on the 5% number is, depending on whose numbers you trust, we're around 1% or 2% of global VC/PE AUM, right? And so if you're looking at that sort of direct venture private equity, we're actually sort of overweighted on the impact side, but it seems that those were very low numbers when I went to look in terms of how much actual direct private capital comes to India. So perhaps there's a larger situational question there. But when I look at the impact industry, certainly it is an entrepreneurial talent that jumps to the top of my list, and the creativity and that sort of business creativity and execution that you see across the country and across sectors, and just the scale of opportunity that one sees, and really the alignment and the intentional alignment of financial returns and social and environmental benefit that seems to come so naturally to so many entrepreneurs in the country. That's exciting and unusual around the globe. Regulatory certainty and compliance has certainly been a challenge. The currency and the cost of hedged debt globally has certainly been a challenge. And then when you are outside of the most sort of developed parts of the business ecosystem, you of course have many gaps in the business ecosystem that makes sort of where you're sort of having to bring everything to bear in some of the more challenging regions of the country as well. And so those systemic gaps are also difficult.
Got it. Thos, do you want to go next?
Yeah, definitely. Thank you. I would say that the opportunities are definitely one of the attractions of India. I would say as a market, there's so much to be done that is just phenomenal. I think as Adam already indicated, the entrepreneurship and the innovativeness, also the opportunity to scale up. So if something is successful, there will be a market that immediately is attractive enough for all types of capital. So we might be more early stage, and that's also then on the flip side. So when you come to a point where actually we feel that our investment comes to maturity and somebody else is better equipped to take on, it's not always easy to find somebody because of the lack of capital. So the depth of the market is one thing. I mean, the 5% is interesting because for us, in our global portfolio, it's quite a bit more than 5%, actually getting to 15%. And that is because there are so many opportunities. For us, that is a problem again, because you can look at India as a continent, which we do, to justify the high percentage, but actually we've seen that in monetary policy, for instance, it is a single country. So there's a limitation. Thank you.
How would you react to the point that Adam called out about regulatory certainty and compliance being an issue? Is that something in your mind as well?
Yeah, I do hear that from our people on the ground as one of the hurdles that requires more attention in India than in some of the other countries we're active. Yeah.
Can you say a little more about what specifically are the kinds of things you're referring to when you call out regulatory uncertainty and compliance?
Well, it's predictability mostly thereof. So you have a certain framework and you work within the framework, and then you need to be able to anticipate on that framework being consistent. And when there's hesitations, that sort of blocks things. Yeah.
Ross?
Sure. So I'll start with the risks, and actually I think it's probably been well covered, and I did poll our team on this question because I think it's an important one to give feedback on this group. Certainly the regulatory issue was played back fairly loud and large, and I think, look, clearly when you're working in emerging markets, there's always going to be a degree of volatility and change from a regulatory standpoint, but I do think that will be a material factor. And I think as we've just heard, that the question of regulatory certainty, or more certainty than perhaps has been the case historically, I think is a factor in building investor confidence. The other point that was a risk, which was interesting as reflected by my team, was the sense that, and I think I think Adam alluded to this as well, but there are areas where there may be underinvestment in potentially the base of the pyramid, and this can create various challenges in terms of just the overall system, the balance that exists within the system. Clearly, India is a very complex and very rich and diverse society and economy, but when you have disparate levels of investment at varying levels of society, that can have the effect of undermining or weakening investor confidence, particularly from a fiduciary standpoint. In terms of strengths, and again, I think very loud and large called out, we talk about the SDGs, for example, where the funding gap, I think, is annually seen as around $560 billion as a gap. And so you've got institutional markets all around the world who are looking more and more to deploy capital in line with SDGs. So clearly there's a market opportunity, and despite India's very strong GDP growth over the last period, there's still significant room for that to accelerate and to grow. So clearly there's market potential there. And the second one, I think, is just a comment about market maturity and an observation that certainly over the last 2 decades, there's been a significant maturation of the impact investing market within India, high quality opportunities. And with that, I think, a recognition that there's improved exit opportunities as well. And so an IPO as a valid exit strategy is not unheard of, and again, that's very attractive. And so whether it's sale of an asset to a strategic buyer or indeed moving something towards IPO, there's the potential to accelerate that, which is a very strong asset in an emerging market as diverse and as exciting as India.
I think an important question in the minds of the LPs in India is really how are global investors thinking about India and what they should prepare themselves for. And as we lead into that, maybe a good point to start would be from just getting your own perspectives on what do you think is going to happen to your own access to capital pools going forward over the next few years, because I think that is the starting point of then beginning to think about where you will deploy, how you will deploy strategies, etc. And maybe I can begin with you, Anita. The whole pensions space. How do you see your access to capital pools evolving, given the general economic stress that economies are under, the trend that we are seeing in demographics globally, etc.?
So I would say, as a long-term investor, as the pension fund, one of our motivations for going beyond Canada was really that given the demographic profile of our pensioners, we have to make up more of those flows from what we earn than what is contributed to the fund. So fortunately for us, we are still in the growth phase. And because of that, for the next several years, I would say that we are looking at really going for those risk-adjusted returns that can keep the flows into the fund healthy. And with every crisis, as you rightly pointed out, whether it is the GFC or COVID, that beautiful track record we've had of 10% Canadian dollar returns does get impacted. But the way we are looking at it, precisely because we are long-term, precisely because we don't have that much volatility in our flows, is really where can we invest in where we can earn that risk-adjusted return with more stability, and do that with really understanding the true long-term risks. And that's where the ESG aspects have become more and more. I mean, I've been at CDPQ for 4.5 years, and I've seen a real increase in terms of awareness, action, collaboration, and bringing together institutional investors towards the ESG theme.
That's great to hear. Adam?
Yeah, I mean, I think, generally, how is India perceived and how does that affect, our access to capital as an intermediary? I do think that there continues to be too much of an undifferentiated view of emerging markets amongst even sophisticated investors, right? And so, India gets the short end of that stick, I think, often, and is seen only in terms of the risks as opposed to the growth, and a really sort of misperceived, I think, sense of the risks. But again, obviously there continues to be significant interest both from an economic growth perspective, this year notwithstanding, but hopefully we'll juice future years, and of course from an impact perspective as well. I'm very interested, though, to see, so for us it will continue to be probably the large family offices. We've got institutions, foundations, and families. But it is interesting to look at the recent spate of SPACs, right? Of impact SPACs. You've got AEA and Bridges issuing a $400 million IPO for a blank check impact, climate change crisis, real impact, another $200 million listing. So this is a new, just over the past few months, a new modality of raising capital into the impact space. We have no specific plans for that, but I think it's an interesting trend to watch on the access to capital space.
Thank you, Adam. And Ross, I know you have a very interesting pools of capital, and so would love to hear your perspective on how you think that's going to evolve.
Yeah, thank you, Rupa. I'll pass it on to our investors that they are interesting, which definitely they are. There's about 60,000 individuals and institutions, but not real institutions, mostly churches, church-related institutions that have been funding us for all these years, and they're extremely loyal, and we've tested their patience and their commitment over the last months, obviously with the crisis and the impact it has on our credit, on our asset portfolio, both in equity and in credit, yeah, extremely proud to be saying that they continue to back us up. So that also means that when there's no dividend and there's no outlook for dividend, people are still joining us, and there's new money coming in, and there is money going out, obviously, because people have their own crisis to deal with and need their liquidity for those purposes. But I'm pretty sure that we will be able to count with them going forward and actually expand the impact we can have as an organization. And we've used this crisis to work on a new purpose-driven strategy process. So the crisis will be over one day. We know that. We had our intentions to start working on a new strategy. As a cooperative, we do that as much as we can with the 60,000 members that support us. So it's a very interesting process with interesting people, and hopefully it will give us an interesting strategy, which will make it more impactful even. Yeah.
Yeah. Thank you, Ross. Ross.
Yeah. So we're a fund that's growing fast. We run impact as an asset class within our broader funds under management. Around about 10% is the target threshold that we run to. So whilst ever we're growing, we'll always be looking to deploy more capital. We have a very diverse impact investment portfolio, multi-sector, multi-geography, quite a split between domestic impact investments, even in Australia, as well as a very broad range of investments globally. We target both growth assets as well as defensive assets. We run our impact asset class as we would consider any other investment. And so whilst ever we see people voting with their feet and joining our fund, or funds that have an interest in seeing their money deployed and to be working both for financial return as well as impact, we will continue to be searching for and trying to leverage high quality impact investments in line with all of the fiduciary obligations that we're targeting. I think there's an interesting question there around the pipeline of suitable investments, and as more and more institutional money starts to move in this direction, of course, and other panelists have commented on this, that raises some interesting questions about quality and integrity of impact and all those sorts of things. Of course, there's lots of good work that's being done around how to improve measurement and all those sorts of things. They are fundamentally important questions. I think that as fiduciaries and certainly as investors, we need to be partnering closely with investees in improving the rigor around all elements of that particular aspect of impact investing.
I think all of you have indicated that access to capital for it looks like you are all optimistic on that front. And so let me push you a little bit. Do you think given what you know, where you sit today and the state of the world, what you know of India, do you think as a result of this crisis, your capital allocation to India is going to increase, stay about the same, or come down? Ross, let me begin with you.
It's very hard to say. I think we will, whilst ever we are growing, impact investing is a critical part of what our members expect us to be doing. Whilst ever we see a suitable pipeline of investments coming from India will always be an important consideration for us. It's difficult to say whether that would be weighted in preferential terms against other particular geographies. Diversity is the key for us, and we would be always open to, and our team engages very broadly with a number of different investees or opportunities in India. So hard to say. We're certainly not seeing it reduce. Be cautious to say we'd see a massive increase. I think we just want to have balance and diversity in the portfolio. That's always going to be a key consideration for us.
Sure. Thank you. That was very useful. And Anita, I know you have to drop off in a bit, so let me come to you and ask you the same question about where do you see India going in terms of your capital allocation? Higher, about the same, lower going forward?
I think in the immediate future, we are focusing mainly on our existing partners and looking at and doing some homework on sectors that post-COVID we think would be the ones to really invest in. And my assessment is very much like Ross, that from a long-term perspective, India is a market that has many of the parameters that we are looking for, including opportunities on a long-term basis to invest in. So I would predict that the amounts should go up. Just give you a number, in the last 5 years, the Canadian long-term investors collectively have invested $50 billion in India. So just from a portfolio perspective and, investing further in those portfolios, I think the inflow into India will continue to grow.
That's very impressive. Thank you, Anita. Adam?
Yes, look, from our firm as an intermediary's perspective, we're absolutely recommitting to India, both from an economic opportunity, as valuations adjust perspective, but also from a need perspective. It's an opportunity to really make headway in both inequality as well as in climate change, and these problems are not pausing. But I do think that it really remains to be seen over the next 6 months how the pandemic plays out and how the economic situation stabilizes or does not stabilize, the degree to which global capital markets will agree with our enthusiasm.
Right. And Thos, you already mentioned that currently 15% of your AUM is deployed in India, and how do you see that going forward?
Yeah, we're pushing really hard all the other regions to step up, so India can grow. Because there's certain limitations, obviously, and the others have mentioned it. So the diversification for us is throughout emerging markets. So we need to have that in balance. There's great opportunities in India, but we have to balance it out. Unless obviously the risk really reduces in India. But I think if the risk really reduces, probably the social impact is also less to be desired of. So we move on to other markets. Yeah.
No, thank you. That was very useful. Let me now move on to the last segment of questions, and before we open it up to the audience, and I believe there are lots of questions from the audience, so we should go to them as well. Speak a little bit about impact and how you think about impact, how you measure impact. I know you've done a lot of work. I was really impressed by the framework that you outlined when we met in Mumbai a few months ago. But would really love to hear. And one of the things we are seeing as impact investors ourselves is that impact means different things to different people. And I think hearing your perspective as a very seasoned investor who has thought long and deep about this would be great.
Yeah, thank you. No, indeed, that's the thing that moves us, right? And you can see it in the tagline, investing in people. That's all we do. And we can't do that ourselves. We do that through partners who we finance. But the measurement of the amount of people that actually have the opportunities to move a little bit out of poverty, that the low-income people that have an opportunity to improve their livelihoods, that's what we want to achieve. And that's hard to measure. And like you say, it's different for many people. But we try to measure it as good as we can. In agriculture, we try to measure actually which crops have given a price to farmers, smallholder farmers, that was above market. Have we found value chains that we can participate in, organizational forms that actually give value to farmers? We track whether we work with cooperatives or not. We truly believe that cooperatives actually have an opportunity for farmers' members to be better off if well managed. So we then, through our capacity building, obviously give more than money to make sure that they can use those opportunities. There's many parameters we check and track, to what extent people actually do move out of poverty. So with partners actually that measure, because the snapshot, the photo is nice, but it doesn't mean anything. You need the movie, you need the consecutive snapshots. And And I think that is also where in this crisis, probably there's opportunities to start working with our partners in different ways to be closer to the tracking, be closer to the measurements of jobs created, and actually then to verify whether those jobs indeed are the kind of jobs we're looking for with the sustainability and the fairness in rewards. So I would say, Rupa, there's too many things to look at, and we sometimes drive ourselves crazy. I think the biggest thing for us is the starting point to work with these partners. Where any partner we work with, the due diligence is ferocious, because once we are in, we don't want to go out unless for the right reasons that we're no longer needed. So I would say at the check-in, we need to be fully aligned on what we want to achieve and what the mission of the partner is or the company and what our mission is, and then do it together.
Right. Now that makes a lot of sense. Thank you, Ross. Ross, so your perspectives on impact.
Yeah, so look, we work very closely with the various groups who, so Gin, for example, the definitions of impact around additionality, intentionality, or materiality. I think these are all very important dimensions. We also signed on to the IFC operating principles for impact. So there's a lot of work being done to try to help the industry, I suppose, scale with integrity. I actually think that the question of defining impact, my career has been both in the commercial sector, but also many, many years in the development sector. And development is complex. You know, I think we sometimes have a naive assumption as investors. We turn up with money and money is paid and impact is an output. And if you pay twice as much money, you'll get twice the impact. Well, development doesn't work that way. And you know, the complexities of a theory of change, you know, there are many development projects that actually can create more harm than good. And so you've almost got this clash of cultures between if you like, the bankers who just want, you know, we expect a linear equation, and the development practitioners who say it's just not that simple. And so the wisdom is, and intermediaries, the work of people like Adam and so many other intermediaries is so important right now, because they play a role as intermediaries working with the bankers or the investors and the practitioners on the ground to find a narrative that is pragmatic, is scalable, and is sensible around what actually is impact. This is a critical question, particularly as the market does scale and you start to get much larger entrants coming in. And of course, there's a marketplace narrative around greenwashing or impact washing, which I think we're all aware of. But I do like the simplicity of some of the work, particularly around gin. And for us, you know, we ascribe very strongly to the views around any investment that we want to call an impact investment does need to meet those criteria of additionality and intentionality and all the things that support that.
Thank you. Adam?
Yeah, no, I'd like to second all of that and say, you know, when we do these very focused funds, so we can link our carried interest, in fact, to things like megawatts deployed, you know, multiplied by number of small systems. And so, you know, that's relatively easy when you're doing, you know, outcomes-oriented funds as opposed to diversified products. You know, that said, you know, that's nice, but, you know, why are we taking these outcomes anyway? And it's really to try to have a systemic impact. And I think that's really the sort of next frontier. And that's where, you know, that's similar to what Ross said. And those systemic impact could be negative, right? Obviously, we're hoping that they not be. But, you know, those complicated impacts, you know, are you really making a difference in the energy system that's decarbonizing it, or around inequality, or the, you know, sort of broader problems for which any of these direct impacts that we're measuring are sort of useful, but are they really leveraged, and are they really moving the system in the right direction? And that's still, you know, areas that we're just waving our hands at, and I think is an interesting frontier, because that's what ultimately what we're all here for, is to make differences in these very large problems which are too complicated for the direct metrics.
Thank you, Adam, and, you know, thank you, everyone. I think this was very rich, very wide-ranging, and I think your comments and observations have sparked a lot of questions. And we do have about 8 minutes more. So let me jump into some of them and the audience questions and bring them up. I think there was a comment during the panel discussion that everyone tends to lump all emerging markets together. And so the question I have here is that, how do you benchmark the India impact investing sector compared to other emerging market impact markets? So maybe we can begin with Ross. And I can request Ross and Thos to take this question.
Yeah, I think it's a valid observation, and it's such a broad brush to. I mean, every national and even within national jurisdictions, there's incredible diversity. I think that, and certainly our investment team who source deals, and we're very often petitioned globally by very good investees and very good opportunities that come from a range of different markets. I think it's probably fair to say there's not a view that we would take that would preference one geography over another. We talked earlier about the importance of diversification and ensuring that there's appropriate balance within the portfolio itself. I think any geography that we're going to be looking at will consider a number of different factors, from political stability, the regulatory environment, what's happening in the markets, and where there are opportunities, where we think there are where we think there's upside in particular sectors or something like that. So we're looking at diversity from a sector standpoint, diversity from a geographic standpoint, and overlaying that with what's going on with the political or the regulatory environment within a country. And again, all of those factors will then be tried to, I guess, weighed in balance, and whether that's about India as opposed to another geography, I think the same sort of criteria would apply around any investment considerations or pipeline that we'd be looking at.
Thank you, Ross. Thos?
Yeah, it's probably very similar to us. I think when looking at applications we get for certain investments to make, what always strikes me is the ones coming from India are the ones with almost the triple-digit percentages of growth. Yeah, I mean, and it's very hard to say no, but it's also very hard to believe straight away. Then most of them do come true, though. But I think that's what sets India aside a bit from the others. But overall, we just look at the impact we want to have, and in India, as much as in other countries, we have to be very cautious because the impact has to be for the people who deserve it and not for the people who create it. And that sort of that scrutiny is in India as much as in any other market.
Thank you, Thos. There's another interesting question here, which I'm going to request Adam to comment on, which is how much risk can impact capital take compared to market capital?
Oh gosh, well, I mean, that gets into the diversity and heterogeneity that Thos and Ross were talking about in terms of emerging markets. That's true for impact capital, and I'm afraid there is no such thing as impact capital as a useful definition, right? There is impact capital that is just seeking for return of capital and very much of a prioritization, and then there's impact capital such as what Anita has, right, where it's fully absolutely fiduciary, and Ross too, right? Where there's no difference in the risk-adjusted return expectations of their impact capital. That said, you can always, what is market rate always also becomes quite Talmudic, because you can have a tranche that's market rate, and with all the catalytic and blended capital that one sees, you're able to use philanthropy or concessionary capital underneath it. So that is always a question to ask. When you meet an impact investor, if someone says, "Hello, I have impact capital," that is not a useful statement for someone to make. You then have to ask that person, well, what is the flavor of it? What are you seeking to achieve? What are your return expectations, and so forth? And so I'm afraid that you'll find that those answers are all over the map.
I think you've gone on mute, Adam.
Oh, no, I think, yes, so as to get to the next question, unless Ross and those want to answer any more on that.
The next question is, your perspectives. I think all of you gave a very clear sense that capital is not going to be a constraint, at least for you. But the question here that I have is your perception on the supply side, of supply of quality investable opportunities. And the question is, if indeed impact investing goes mainstream, does the industry have quality supply to manage the demand for impact assets? So do you think, in other words, there are enough high quality impact investment opportunities out there now? And I'm unfortunately not able to figure out whether this question relates to India. I presume it does, or whether it's more general. But anyone who wants to go first, please step in.
I'll make a couple of brief comments. My simple answer is no. My view is that if institutional capital really begins to flow at scale, I think you will very quickly exhaust the supply of, I'd call them quality projects. We're interesting. I mean, we're not a large pension fund in the grander scheme of things, but we're a pension fund that is very well known for the work that's been done around impact investing. And so when there are good opportunities globally, we'll typically see them. You know, it's quite collegiate, quite collaborative. And we know, even at the sort of ticket sizes that we'll be investing, let's say low end, probably say 2 million up to around 40, 50 million. We've got much bigger pension funds who won't look at anything, you know, south of 100 or a couple of $100 million. The reality is you're very quickly going to exhaust that supply. And so market building is critical. And there's a real opportunity for India in that. We've talked about the upsides and the potential that India has in that regard, particularly the maturation of exit strategies. And you know, you're starting to see investments grow at a scale and a quantum that can potentially become very attractive to much larger investors. But right now, I think if you turn that tap on hard, you'll very quickly exhaust the supply of what we'd say. And we're a fiduciary. We operate at a certain end of the risk return spectrum, but I think there's a paucity of supply.
No, thank you for your candor, Ross. I think that was a vital call out. Adam and Thor, some quick comments on this question.
I'll pass on this one, Rupa, because I think if there is enough in the market, we will probably be leaving. If mainstream takes over, we're no longer needed.
Right.
And we're still needed, so that shows that it's not mainstream yet.
Right.
And if it does come in, I'm just perhaps optimistic that the market will meet that demand. You know, I agree it's not there now, but it would not take too long. Market building is critical, but I think that the elements are there to scale up to meet that capital should it really arrive.
Right. Thanks, Adam. And the last question, which I'm going to put to Thos, because I think your comment on 60,000 individuals was quite intriguing. And the question is there scope for a more retail cooperative based model for fundraising for social impact?
Yeah, well, that's what we are, right? So and one of our objectives has been, and successfully over the years, to grow the movement, as we call it. It is a cooperative of individuals, but it is more than that, and it shows that there's many more people that have that same sort of philosophy and the same value set. We will just have to see how we come out of I mean, there's going to be a crisis here in Europe or in the Northern Hemisphere, which will affect people's opportunity to invest. And interestingly, most of our investors aren't extremely wealthy people that just allocate part of their assets to us. It is people with relatively small means that dedicate a fairly large part of that to us. So that is an interesting characteristic when you think about setting up a retail funded organization.
Terrific. And with that, we come to the end of this really fascinating discussion. I think first I want to thank all of you for coming here today, for sharing your thoughts, and above all, I think for being so candid. I think the messages you've left with us are very clear. You love the entrepreneurs, you love the opportunity for impact, but India has more work to do on the regulatory front, on the compliance front, and also I think on the quality of assets. I think we heard a mixed set of answers there, where some folks were more positive than others. But clearly, I think in market development, for generating a greater pipeline of impact assets, I think there is where work remains to be done. And I think that's an important agenda for the Impact Investing Council to take up. With that, all that remains for me to do is to thank you all once again and bring this session to an end and hand it back to Neha. Neha, over to you.
Thank you, Rupa. Thank you, Ross.
Thank you.
Thanks, Rupa.
Thank you. Thank you, Rupa. Thank you, all of you. That was an extremely interesting session, and it was really excellent to hear some insightful views and perspectives on the broader view of the impact sector. Thank you, Rupa, for your excellent moderation, the panelists for joining us, and the audience for the questions. Indeed, there is a silver lining to this pandemic, and most of our panelists have shared an optimistic outlook towards impact investments in the post-COVID world. So with that positive note, we now close the session and move on to our next, which promises to be another exciting round. It will be a deep dive into Indian impact investing journey with another illustrious panel comprising of veterans of the Indian impact investing story over the past few years. For that, I hand it over to Ranjana. Thank you, everyone.